Welcome back to another video, and today I want to show you one method of evaluating a stock. If you are new here, on this channel I'm documenting my Wealthsimple trade portfolio as transparent as possible. I use a value and dividend-based strategy to preserve and compound returns over time, and that is why I'm going to be discussing the dividend discount model today. Portfolio is currently sitting at $17,769, and with consistent contributions and buying profitable companies, I predict this will grow over time. Today, I'm going to be evaluating one of the most recent holdings I am averaging into, Alimentation Couche-Tard. This company owns and operates convenience stores across Canada, the United States, and Europe. Their brands include Couche-Tard, Circle K, and Ingo, which have their own area of operations. Their stock has done extremely well over the last decade, growing revenue while also keeping operating costs and payout ratios low to optimize reinvestment. To see this better, let's look at the dividend tracker to see some of the dividend payouts it has been producing over the last few years. So if we look at Alimentation Couche-Tard in the dividends tab here, we can see all of the dividend payouts from the previous 13 years going back to 2010. Despite having a low yield of about 0.9%, they have a dividend growth rate of about 19.2% with a dividend streak of 18 years in a row. The current annual income is sitting at 56 cents and they pay quarterly dividends. It is important to check if the company can afford this aggressive dividend growth rate of 19%. You can take a look at their payout ratio. It's very reasonable at 15%. Now that we know their dividend is not at risk in the near future, let's try to calculate their price based on their dividend growth rate. The dividend discount model is used to calculate a price of a company based on the future growth of its dividends. The formula is the future dividend divided by the difference of the discount rate or the cost of the equity minus the growth rate of that dividend. The higher the discount rate, the higher the dividend growth rate must be to compensate for that rate. So it's best to use companies that have longer history of dividends that are also not at any risk of changing the future growth of that dividend. Despite the calculation being quite simple and logical, we have to note that the discount model is a rough estimate based on previous years. And of course, that doesn't guarantee any future returns because of a few assumptions we have to make. So the first assumption is the dividend growth has to be constant or relatively constant. Economic outlooks, interest rates, and industries change over time. And there's no way of predicting these types of variables when calculating the stock. So this company is in convenience stores, in the consumer discretionary. This will change depending on how the economy is doing. The second assumption is related to a company's dividend growth rate. In theory, a company will never be able to continually grow faster than the economy. So we have to assume the company will be able to maintain a stable growth rate. So that is what we have to determine with Alimentation Couche-Tard, is what their stable growth rate will be over time. The model breaks down as the growth rate approaches the discount rate. So because in this formula, if we have the cost of equity and growth rate relatively the same, this will be zero and the expected stock value will be infinite. And that is where this model does break down, is that we are assuming that the cost of equity is larger than the growth rate. And lastly, we have to assume there are appropriate payout policies and management doesn't change these policies over the course of the company's life. So if they begin to reduce their payout or increase their payout ratio drastically, that will change the dividend growth rate and that will change the outlook we have in the dividend discount model. Okay, so now that we know some of the side notes of the dividend discount model, let's try to evaluate Alimentation Couche-Tard. I've created this calculator that takes in dividend payouts and it will calculate the dividend growth rate, and then we have to deduce how much growth will slow down over the course of Alimentation's lifespan, that we can get a rough idea of intrinsic value of the company. So let me put these past dividend payouts in and I'll get back to you. So I have imported the quarterly dividend payouts here, and just in the row below, it has the annual payout. And we can see that the average growth rate is just under 23%. And this is fairly accurate because the dividend tracker was about 19 or 20% dividend growth rate. So now our job is to come up with a percentage that the stable growth rate for this company. Now, this is going to be quite a bit smaller than 23%. From our assumptions, we know that we cannot grow faster than the economy, and we need to determine a normal, stable growth rate, let's say maybe 9%. Because as the company gets larger and gains more market share, the company in general will have slower growth, and their dividend will also grow at a slower pace. Now, with a 10% discount rate and a margin of safety of about 10%, we come out with a buy price of $50.40. So the price of Alimentation Couche-Tard is $60. The dividend discount model gave us $56, but with our margin of safety, we want to make sure we're buying at a good value, and that puts this company at $50. So currently, Alimentation Couche-Tard is technically overvalued based on the dividend discount model. I do believe this company is fantastic, but at $60, it is fairly high. That's it for the dividend discount model. Thanks for stopping by for another video, and make sure to subscribe to the channel if you like this type of content. If you want to check out the dividend tracker, there's a link in the description. They do have a free account you can try out before committing to the premium version. Till next time.